Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And of course, joining me today is Michael Becker.
Hey, Paul.
Michael also with Old Capital. So we're in the podcast today, and we're excited to have, I think, one of the preeminent loan underwriters that we do business with. And I think it's going to be a treat for you to kind of listen in and kind of be in on a private conversation that we're having about non-recourse lending. And I think there's not a lot of community banks or a lot of regional banks that do non-recourse lending, but we do have one that we do a lot of business with. We'd like to do a lot more business with. And so we're going to talk a little bit about what he likes and what he doesn't like and how to structure transactions. And I'm going to welcome to the podcast our friend Jonathan. Hey, Jonathan.
Hey, Paul. How are you?
I'm doing good. Jonathan, tell us a little bit about why people do business with you.
Well, there's a lot of reasons that they do business with me. One of them is I got a product that nobody else has in large form. It's a non-recourse bridge loan. So not a lot of competitors out there with those two parameters. So generally, bridge loans are obviously require some work to them, and a lot of lenders want guarantees in place on that type of loan structure. So from a non-recourse standpoint, we don't have a lot of competitors. So
yeah, that's a great point. And I'm going to kind of have Mike kind of kick off the call in this visit here, just because Mike has a background of being a recourse lender in his previous life with a large regional national bank. Mike, tell us a little bit about why most banks just do recourse lending.
Sure. When I worked for community banks and the large national bank in my background, most of the loans that we did, as you alluded to, Paul, were all recourse. We always wanted someone to sign the note and stand behind it. And before we started the podcast, Jonathan and I were kind of having a little side discussion. And back in the depths of the recession, usually by the time we had to go get our guarantee, it never really was worth much anyway. So it was kind of a funny aside. We were just talking about that. But the banks want someone to stand behind it more, to just kind of be someone to help them unwind and orderly liquidate the asset in the event of a negative outcome. So that's what most of the banks want when they have a recourse, as well as it can tell their regulators and the bosses that they have, a secondary repayment source.
And so when we typically see maybe a non-recourse bridge loan, most non-recourse bridge loans kind of come with a higher interest rate on it, maybe 7, 8, 9, 10%. And Jonathan's loan is not even close to that. This is a very reasonable kind of community bank interest rate that is very reasonable. So that one of the reasons why we do like Jonathan's loan is that interest rate is a great and a positive way of selling it to the customer. So let's kind of talk a little bit about structure and what type of transactions Jonathan's group will do. So let's talk a little bit about multifamily. Let's talk a little bit about office. Let's talk a little bit about retail, and then some warehouse, industrial kind of lending. So, if anybody in their mind's eye can try to kind of keep those four food groups separate, there may be similar terms within that product type in their underwriting, but I want to make sure that let's handle multifamily first. So multifamily, Jonathan, tell us a little bit about where your strike zone is for multifamily.
So on multifamily, in general, our strike zone for loan size is anywhere from $3 million on the bottom end up to $25, $30 million on the high end. We've done less and we've done more than that, but to give you a kind of a target, that's where we're going to be, with the bullseye obviously being kind of in that $10 to $15 million mark. And we've seen a lot of activity in the multifamily sector over the last 24, 36 months. We've seen a lot of activity from all food groups, but that one certainly takes a lead. That just seems to be the most moving sector right now.
So when you're structuring a loan or you're looking at a request, what are you guys looking at? Multifamily or just in general? What are you looking at what do you want to see when I bring you a request?
So we are multi-tenant cash flowing lenders. So to kind of take that one piece at a time, multi-tenant That's why those 4 food groups that you mentioned, Paul, are all achievable with me. Is generally every one of those food groups has or can have a multi-tenant aspect to it. Multifamily fits it very well. Office generally fits it very well. Retail the same. Industrials where we get a little harder to fit the platform just because it's fewer tenants and for the most part. So we'll take industrial when it's a flex type office where there's multiple suites in it, different tenants, or in a portfolio setting where there's multiple properties.
So why is that important to have multi-tenant? What's that so critical for your group?
Diversification. We never want any one tenant to kill our deal. So if one tenant blows out, we've still got cash flow that we can rely on, and understanding the market economics around that vacancy, understand that we're still good on our cash flow.
So when I bring you, obviously multi-tenant, it needs the cash flow day one, right?
Right.
So what are some kind of the key metrics you're looking at when you're sizing a deal up onto how much you can go from a loan to cost or just a general loan, overall loan proceeds?
Yeah, so again, I am non-recourse, so I'm not going to have the higher leverage that a recourse lender would have. They're generally going to be up to 80% loan to cost, loan to value through a rehab. I'm generally going to be in that 65 to 75% range on the top end. So on multifamily, we'll just kind of take that one. That obviously that's the one that's been most active recently. So generally, we'll take trailing income over trailing expenses to look at what the in-place NOI is when we close. I'll size an initial funding level on that cash flow so that I know that whether you do your rehab or not, I'm good on my initial funding based on the cash flow that's existing. Then from there, it's really just sizing up what is the upside in the property. Is it a exterior and interior complete gut job, or is it, hey, the interiors are done, we need to replace roofing? What level of increase in value is achievable? And so really kind of sizing the holdbacks from there. Generally, the deals we're going to see is an acquisition with a rehab component to it. So we will hold back the rehab dollars within the loan commitment and fund those out as they're needed through the rehab.
So when you guys are doing the progress draws upon work being done, so what's a little bit unique to your product, say relative to like a Fannie Mae loan, which we talk a lot about on this podcast, is when you do a Fannie Mae loan, the loan is fully funded, and if you have $500,000 in renovations, that'll be held in a money market account in escrow, and you'll pay interest on the full committed loan amount. With you guys, you would withhold that $500,000 from the actual initial loan advance, and you'd only pay interest on the outstanding.
Right.
And then as you obviously loan up, you'll pay more and more interest as the loan balance gets bigger. So that's,
Right.
I think, a key benefit to what you guys do, as well as having some flexibility overall.
Well, and it helps not only the investor go through the rehab project, but it helps me as a lender sell it to our committee because we start off on such a lower level loan to value because I'm not fully funding those dollars day one. So it helps me say, hey, we're going to be committee members, we're going to be at 60% loan to cost, loan to value on the front end of a deal, and we're going to fund out as the progress is achieved, and we know that the progress is happening. And so we'll fund out to that higher committed loan to value.
So you do the progress funding. Do you guys escrow for anything else within your loan?
We do, as the deal needs it. So with every deal we do, we will get a property condition assessment report, which will, obviously an engineer will go out and visit the property and identify any short-term, immediate, and long-term needs that the property, in his judgment, needs. A lot of times the immediate and short-term needs are taken care of in the rehab budget and the holdback that's been presented, but a lot of times there's going to be long-term needs that are going to be over the period of 1 to, say, 10 years from today. And so depending on how that schedule looks, we will escrow for any material amounts that are needed along the way within the loan term.
What about taxes and insurance?
We do taxes and insurance as well. That's on every single deal.
Oh, good. Okay. So maybe kind of moving a little bit away from multifamilies. We talk about that a lot here. So office is probably the next biggest food group for you, right?
Right.
Maybe I think most of the people on the podcast are relatively familiar with how multifamily works. Maybe you can kind of do a quick little compare and contrast on what key differences you guys look at, or what would you look at on an office building relative to like a multifamily property?
So the underwriting really from a high level is all done the same. Again, just kind of that multi-tenant and cash flow. So we're looking at obviously the diversification within the tenant base, but obviously with office tenants, you have longer terms. So you have rollover risk within your tenant base that you have to consider looking at over the term of the loan.
So what might be something, so if you go out and you give us, say, a 5-year term and there's relatively large percentage of those leases expire, say, in year 2 and year 3. What do you guys do when you look at that? How do you structure around that?
So there's no just black and white answer to that.
Yeah.
Obviously, we're looking at the leasing cost to replace that tenant. Generally, we'll overlay a 75% retention rate on the tenant. So 10 tenants are rolling out, 7.5 of them will stay. But the other 25%, we're looking at, okay, what's the TI dollars to backfill that? What are leasing costs? And for those that are rolling over, we'll escrow with the cash flow until we get to that point.
And just so we clarify, so TI is tenant improvement allowance. So when an office tenant moves, the next one that comes in is going to want the landlord to give them a certain dollar per square foot,
Right.
$10 to
That'll
$20
vary.
in
Yep.
this market.
Sure.
Maybe higher if it's a better class property to reconfigure the space for their needs. Leasing commissions, typically an office and retail industrial, there's typically about 6% commission of the total payments in a lease that are due to the brokers that they either represent or bring the tenant to the place. So that is paid, and then usually that is financed within the loan or held back within the loan as a reserve, right?
Right.
Good.
So, yeah, to clarify, bring me a property that's 75% leased in a 90% market. Obviously there's upside for 15% occupancy there. And so we'll have within the holdback a leasing holdback for that space. But that's currently vacant space when we close. The rollover risk is a different bucket, and that's existing tenants in that 75% occupancy that have the potential of rolling out over the term of the lease. We'll want to escrow along the way out of the cash flow for those leasing costs.
So obviously we've hit that you want diversity in your income and your tenant base, but at what point do you start asking for things like financial statements and some of the tenants? At what sort of level do you guys ever get there, or do you make sure that you have to have less than 10% any one tenant, or is there any sort of guidance? Or
yeah, there's
rules of thumb
exceptions
there?
on everything. Certainly, and there's not a magic number to that either. But I would kind of off the bench say anything that's over 25% of the space, we'd want financial statements on. Make sure that we're comfortable with their financial capacity and longevity in that space.
That makes sense. So maybe we kind of transition a little bit over to retail. So retail functions very similar to office, in my opinion. Are there any key differences or any other things that you look for on the retail that you wouldn't necessarily look for on an office building?
Co-tenancy, early termination clauses within junior anchor and anchor type tenants. I won't go into what that is, but high level is if one tenant leaves, it gives the ability of the other tenants to leave as well. And so obviously that can be detrimental on cash flow if that's the case. So, those are the two major components I'd say that we would look at in difference between retail and office.
Good. And industrial, obviously you said that that's a little bit harder, a little bit less of a bucket you do. Is there anything and specifically that you look there versus the other ones?
Yeah, it's not really going to be a financial capacity of the tenants at that point. I would say if it's under, 5 tenants, then that's probably going to get us to a point where we're uncomfortable because you lose one, you're down to 80%, you lose 2, you're underwater. And there's always going to be vacancy, in our opinion. So, and again, I'm a non-recourse lender, so I don't have the comfort of that secondary source of repayment from a guarantor. So, I'm always going to be looking at it from worst case scenario and making sure that my cash flow is protected.
A lot of people that we talk to have a little basic underwriting knowledge and how they think they can qualify for the transaction. Most of the time, the people that we talk to, whether it's multifamily or it's retail or office, they'll always think about debt coverage ratio. Now, you guys take a look at it a little bit differently. You look at a thing called debt yield coverage. I thought maybe you guys can talk a little bit about debt yield coverage and what that means and what are you looking for in a debt yield coverage?
So debt yield, from its easiest formula, is the NOI divided by the debt balance. So basically the same calculation you would do to evaluate a property.
Similar to like a cap rate.
Cap rate, exactly, except you're using the debt balance versus the value on the bottom. So
what are you looking for? What makes a good number that you're looking for?
So in the majority of those food groups, on a stabilized basis, we like to be in a normal market around north of an 11% debt yield on a stabilized basis. So to waver from that and go lower than that, we do that, but it's usually story driven. How distressed is the property? How much upside does it have? Where are we in the market cycle? So there's a lot of things that we look at that point. So it's hard to say what's your minimum debt yield, but it's easier to say what our stabilized debt yield is, because that's where we feel good about where the property can achieve its stabilization at.
Let's talk about when you say good, what do you feel like it's going to be good? Let's talk about a little bit about good news dollars and what that really means on this type of a loan. This type of a loan, being a bridge loan, typically you just fund the transaction, but with Jonathan's group, he has the ability to do good news dollars. And talk a little bit about what that means, Jonathan.
Yeah, so good news or earn out dollars, again, that's one additional carrot that we have with what we do. In addition to the non-recourse bridge lending, we'll also overlay an earn out capacity on the back end of the loan in a separate tranche, a separate holdback, if you will, under the loan. That, again, my loans are centered around performance. So you do what you say you can do, you execute your strategy, you get it from X to Y. And if you do that, and it's subject to a stabilized loan to value, whatever that may be, but call it 75%, as long as I'm within my 75% of stabilized value, you can earn out dollars on the backside to recoup equity at that point.
Now, Mike, I'm going to ask you, since you're an operator, not only a loan officer, but an operator, what does that mean in English?
It means if I do what I say I'm going to do and I turn the property around and raise the NOI and raise the value without having to pay off my first lien, he's going to deliver a additional second lien note, which is basically a capital injection or debt injection back to the partnership, and I'm able to do a distribution to my investors, and they are happy with me. That's what that means.
Without selling the property.
Without selling the property, paying taxes, any sort of commissions, et cetera. It's basically just a way to strip out equity through adding a second lien debt and return capital to your partners quicker.
Does Fannie Mae allow you to do that?
Yeah, in a Fannie Mae product, they will have the ability to do a supplemental loan. It seems like that supplemental loan is similar to the good news dollars that Jonathan was talking about, except that with a supplemental loan, they're going to do quite a bit more extensive re-underwriting of the deal than what Jonathan's group does.
So Jonathan kind of approves that all the way up front. So
it's like a forward commitment versus with Fannie Mae, you need to go back and then they adjust it up. So that'd kind of be the two differences. So it's just basically a forward commitment that he's guaranteeing you if you hit these certain objectives, he's going to give you the dollars, where Fannie Mae doesn't give you that forward commitment.
And then with Jonathan's transaction, it has to be 1 year at least InPlace Income. How does that look? You have to have at least 1 year of the increased better NOI to qualify for the good news dollars?
For the earnouts, then that again is going to be a case-by-case situation. We obviously want stabilized cash flow. You bring it to me in month one and you've hit the hurdle that you needed to hit, I'll say come back and see me. So I've done them as low as 3 months all the way up to a year. It just really really just depends.
3 months?
Yep.
Wow.
So it really just depends on the sponsorship group at that point, their experience with what they're doing, and how really distressed the property is and where we're coming from to where we're going. So, again, not every deal is created equal, and they all have to be sized a little differently based on all the variables. So
let's get a little bit more granular. What's your term of the loan typically?
Typically, we're very flexible, but typically we're anywhere from 3 to 5 years fixed rate. Lenders will provide interest-only periods on the front end to go through the rehab, generally anywhere from 12, 18 months, 2 years.
Wow.
On the furthest, and that's usually a lower levered deal. And then that will convert into anywhere from 25 to 30-year amortization.
So 25 to 30-year amortization to make your payments affordable over that period of time. Interest only from 12 to 18 months during the rehab of the property. If you wanted a 3-year term and wanted to maybe get an extension because you weren't too sure if you wanted to sell at the end of the third year, you could get a year or two extension for additional fee?
Yeah, so again, let's talk very typical. Typically, every one of my deals are 5-year deals. Everybody wants the 5-year commitment that, okay, I'm good for 5 years. But a lot of times their exit strategy is to sell the property in, say, year 3.
Yep.
But on a 5-year commitment, I have a prepayment of 3-2-1 par. So you're still kind of locked up in year 3. In year 4, you're open to sell it with no penalty. So with a strategy of, hey, I really think I'm going to complete my rehab within 2 years and I want it to be open in year 3, then yeah, I'll do a 3-year deal with a 2-1 par open prepay with a 1 or 2 year option to extend. So if you execute your strategy, you win. If you don't and you need to exercise, there's typically an origination fee on the extension period, basically an extension fee to go out to the next 5 years. So you still have the comfort that it's there, but
You give flexibility.
yeah, it's flexibility from the buyer. So
And you're a bank, so you're not selling these loans. You're going to keep this in your portfolio. So
Correct.
and you're going to be managing the relationship too. So that's great. Where a lot of companies on the bridge side that they will just originate, and then all of a sudden you're working with another group out of Nebraska that's trying to figure out who the heck you are, but you manage the account.
correct.
Tell us, a little bit more about sponsorship, because in a transaction, typically that is a recourse deal. We have collateral not only in the asset itself, but we have collateral on your balance sheet. What are you looking for experience levels for somebody that's going to come in and buy a property? Because I know your minimum loan amount's for $3 million. So is it their first rodeo? Is it their second rodeo? I mean, tell me a little bit about what you're looking for. What's kind of right down the fairway for you?
Well, certainly experience is key. If we're going to go non-recourse into any given property, we want some assuredness that whoever we're lending money to has the ability to do what they say they can do. So, again, there's a lot of variables with that. You have some owners that are also the on-site property managers and self-manage their properties, and they've been doing it for 10 or 15 years, and they have 1,000 units currently on the books. And, so that's somebody I'm very comfortable with. I'll generally get a global real estate schedule on all the other properties so that I feel good about the fact that they can manage their properties. So, but on, say, someone that's less experienced, that's when I'm going, okay, they have some financial net worth, but the experience level is not quite there to go in there and rehab a property. Then I'm looking at who's the property management company going to be. I'm certainly they're going to outsource that to a third party. I want to be very comfortable with who that's going to be. We're primarily here in the Metroplex, and so
Let's talk a little bit about that too. So Jonathan's physically based out of Dallas, Fort Worth area. The bank's footprint will be the entire state. Will you look to go to other states? What's some of the caveats if you're doing a transaction in another state?
yeah, so there's certainly an appetite to lend here within our market. So our physical footprint is here in the Metroplex. So our policy allows us to go anywhere really over the state of Texas with no problems. We will reach into surrounding states as well, border states, but generally those are going to be on an exception base with someone we've done business with here locally.
Yeah, previous relationship.
That said, I did reach into a surrounding state on a first-time deal with a borrower just this year with the emphasis of wanting to begin a relationship with that borrower so that we can get a shot at the next local deal.
Well, what about the inverse of that? If property's here locally, DFW or Texas, and the borrower's from, say, California, how do you guys look at that?
We're okay with that scenario. Again, we have investor groups that, yes, they're based out of California, but they've got a strong presence here in the Metroplex or in Texas or whatever. If it was a California borrower buying their first piece of property in
Tulsa?
Houston, Tulsa, Oklahoma, probably no. We don't know Tulsa, we don't know the borrower, so our assuredness kind of dries up at that point.
Yeah. Another point is a typical community bank is going to require that the entity, the ownership, the guarantors of the transaction owner control 51% of the entity. You guys are not like that. Where do you guys come in at the sponsorships? Where do you want them to come in with cash out of their pocket?
Cash out of the pocket, we're looking for a minimum 10%, of the equity pool going into the deal.
So the guarantors who are going to sign this deal, they want to make sure they have at least 10% of the equity ownership into the transaction, then they can syndicate probably up to 80 or 90% of the transaction. They would prefer more skin in the game, but I think that is just minimum numbers that they would probably be looking for.
So I'll touch kind of quickly on our position on guarantors. Yes, we value them, we need them, we like them. But the way we underwrite our properties is obviously from a non-recourse approach. And so our belief has always been lower leverage, underwrite the cash flow, because the real estate market is cyclical. If you don't believe in that, then we're not going to lend you money. we underwrite it to a position that no matter what period in the cycle we are in, the debt is protected. The equity can be impaired depending on what part of the cycle we're in, but if we underwrite it correctly and we do a fairly good job of that based on our performance history, then if you can make it through the cycle, the downturn, we'll stick with you and you'll get your equity back.
And just so we make sure I clarify too, you two refer to guarantors and non-recourse. What we're talking to is signing the bad boy carve-out.
Right.
So the standard carve-outs against fraud and misrepresentation. So it is a non-recourse loan.
Right.
But if you commit fraud or misrepresentation, then they could spring in a guarantee. So it's very common in commercial real estate. So
Correct.
Anything else that we need to know about that you think is important for either new buyers, new borrowers, anybody that you wish you could tell people?
Well, most of our deals are transactional based. That's what we do, and we like that. We are a bank at the same point. And the only way we grow our loan portfolio is to grow our deposit portfolio. So if you come to me looking for a loan, there will not only be a request for the operating account on the property, but probably additional deposits.
That's
as
not
well.
a request, that's a demand.
It's a request now. It may be a demand later.
Yeah, so the operating account has to be with the bank too. So that's not unusual. They want to take in cheaper deposits so that they can turn around and lend that out. They've been lending out grandma's money, and now they want to lend out your deposits to somebody else.
Yeah, and if we don't succeed in that, then my product dries up and goes away.
Yeah. All right, Mike, anything else?
no, I just appreciate kind of having a good discussion on something that's not just strictly multifamily, since that's what we typically focus on here. So it's refreshing to hear a little bit of the other three of the four major food groups in the commercial real estate space.
So multifamily, I think we understand that. Office, I think we understand that. Retail and industrial, I think we understand that. Banks open for business. You ready to take on more business?
We're ready to go. We've had enormous loan demand over the last 3 years specifically, since the market's kind of turned back in our favor. But don't even count us out when the cycle changes. We were probably the busiest bank in town from 2008 to 2011. When all the other banks were scared to loan a dime, that was our busiest time.
Well, sounds good. Jonathan, I can't thank you enough for coming in and visiting with us, with Mike and I today. And
Thanks for having me.
if anybody else has any questions concerning Jonathan's product or any way need some help on underwriting any transactions, whether it's multifamily, office, retail, or industrial, make sure you call Old Capital. Again, Mike, anything more to add?
Thanks for listening.
Thank you.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.